Whenever the government announces a massive overhaul to the tax code, it is completely normal to feel a wave of panic. You wonder how much more you will pay and how complicated the forms will be. Take a deep breath. The new Income Tax Act of 2025 keeps your tax rates exactly where they are right now. The tax slabs have not moved at all. The old 1961 law was 60 years of piled-up rules and messy amendments. The government is replacing it to clean up the paperwork and move everything online. Think of this like a software update for your smartphone. The apps might have different names now, and the layout looks a bit different, but your photos, your contacts, and your actual money remain untouched. This shift replaces those decades of complex amendments with a shorter, cleaner structure. By organizing the law more consistently, the goal is to make the rules easier to follow and the filing process more digital. For decades, we have had to juggle two overlapping timelines: the previous year, when you earned the money, and the assessment year, when you filed the taxes. Starting in April 2026, those disappear. You will only use one single timeline, called the tax year. Because of that shift, the most famous piece of paper in Indian salaries, your annual Form 16, is being officially retired and renamed. The old terms are getting crossed out. Assessment year becomes tax year. Form 16 is now Form 130. Section 80C becomes Section 123. Now, Form 130 and Section 123 line up entirely under tax year 2026-27, finally matching the exact year you earned the money. By matching the calendar to the forms and rolling dozens of old rules into one place, the government removes the primary cause of filing errors for salaried employees. Let's talk about your house rent allowance. Historically, only renters in 4 legacy cities, Delhi, Mumbai, Kolkata, and Chennai, were allowed to claim the maximum 50% exemption on their rent. Everyone else was capped at 40%. The new act officially recognizes Bengaluru, Hyderabad, Pune, and Ahmedabad as metro cities. If you work in these tech hubs, your HRA exemption calculation is bumped up to 50% of your basic pay, increasing the tax-free portion of your salary. To actually see this money in your account, you will need to submit a revised HRA declaration to your employer. This specific update brings tax logic into line with where the jobs actually are today, putting more take-home pay directly into the pockets of millions of corporate workers. Along with the rent updates, workplace allowance limits have been adjusted to finally reflect modern prices. The tax-free limit for employer festival gifts has tripled to 15,000 rupees a year. The allowance for office meals has quadrupled, moving from 50 rupees a meal to 200 rupees. But there is a strict new rule to be aware of regarding your rent. It is still perfectly legal to claim rent paid to a parent or a spouse, but the reporting rules are much tighter. Take a look at this document, the new Form 12-4. If you pay more than 1 lakh rupees in rent to a family member, you have to fill out these 2 specific fields: the landlord's PAN and your exact relationship to them. The government updated these financial perks to match current costs, but they ask for clear digital records to ensure claims are verifiable. All of these updates, the new forms, the higher rent exemptions, the updated sections, apply strictly to salary credited on or after April 1st, 2026. Remember the main takeaway as this transitions. The math on your tax bracket is untouched. Only the paperwork is evolving. If your company uses modern payroll software, these section name changes and new forms will happen automatically in the background. You won't have to manually calculate the differences yourself. When you understand how these names and forms connect to your current paycheck, you can handle your declarations and benefits with a lot more confidence as we head into April 2026.